You're watching your stock fall, down 3%, down 5%. Your stop loss is set at the classic William O'Neill hard stop, 7%. You're sweating. And then, exactly at that level, it bounces back, up 8% by close. You should have made money, but you missed the entire move up because the exchange knew where your stop was before you did. That's not paranoia. That's mathematics. Let's back up a bit. Here's how a hard stop works and what it's about. If you buy a stock at $100, you can set a stop loss order at $93. So, if the price drops to $93, an automatic sell order is triggered and your position is automatically sold. The goal of this strategy is to protect your capital and ensure a single bad stock pick does not sabotage your entire portfolio. So why 7%?
It's considered the sweet spot, wide enough to let the stock fluctuate through normal market noise, but tight enough to cut your losses quickly if the stock heads south. If you like what you've seen so far, please like and subscribe so we can continue to grow this channel. Most traders think exchanges are neutral platforms, but they're not. They're predatory pricing engines designed to liquidate retail positions with efficiency. And the algorithm that makes this happen has been operating in plain sight for over a decade. Here's how it works. When you place a stop-loss order on any major exchange, NYSE, NASDAQ, even crypto platforms, that order doesn't stay private. It gets fed into a system called the consolidated tape, which broadcasts real-time trading data across the entire market infrastructure. But what your broker doesn't explain is that institutional traders don't see what you see.
They see the aggregate pressure map, so they can see where retail stops are clustering and literally watch the heat map of liquidation points forming across price levels. Think about that for a second. Imagine you're in a casino and you can see everyone's betting slips before the roulette wheel spins. That's the asymmetry you're operating under right now. The algorithm works in 3 phases, and understanding each one is how you stop being the prey. Phase 1 is called liquidity hunting. This happens 30 to 90 seconds before a major move. You'll notice the price starts moving in one direction with slightly elevated volume, maybe 20% above average. It looks like the beginning of a real trend. Your confirmation bias ignites. Your brain says, "This is it, buy," or "The break is coming, sell." But what's actually happening is that the algorithm is testing the market's resistance at known stop-loss levels. It's probing like a shark testing the barrier of a net.
The exchange's matching engine has access to order flow data that shows where retail positions become unprofitable. It knows approximately how many shares sit just below support. It knows the price point where traders' emotional thresholds break. And it has the computational power to execute thousands of microsecond-scale price tests to find the exact point of investor pain. Most people don't know that exchanges make money 3 ways: listing fees, transaction fees, and, critically, lending fees. When your stop-loss gets triggered, that's a forced market sell order. Forced market orders are the most profitable orders for the exchange. The fees can't be negotiated down, and they execute a full retail cost. The exchange's matching engine prioritizes triggering stop-loss orders because each one is guaranteed revenue. Your stop-loss isn't a safety net, it's a slot machine for the exchange. Phase 2 is the spike. Once the algorithm has mapped the density of stop-losses around a price level, it stops testing and starts executing. The price will move hard and fast, sometimes violently, directly toward that cluster, and that movement creates a candle that looks like mostly wick, sometimes called a pin bar, which is short for Pinocchio bar because it lies about the market's direction before snapping back. I should take a moment and explain the candle and wick reference. A candlestick or candle is a visual way of displaying the price movement of a stock over a specific time frame and crams 4 critical pieces of data into a single image: the asset's opening, closing, high, and low prices during the trading time frame. The main body of the candlestick, known as the real body, illustrates the price range between the opening and closing prices. The ends of the wick line indicate the highest and lowest prices reached. Candlestick charts are widely used by traders and analysts to identify patterns, trends, and potential reversals in market prices. So, to continue, the price is moving downward, hard and fast, down 6.2%, then 6.8, Your heart is pounding. The algorithm is specifically moving the price through the stop-loss zone to maximize automatic sell orders. And the algorithm knows that as soon as the first wave of stop-loss orders trigger, panic selling accelerates. Those liquidated positions then add more downward pressure. The algorithm is literally harvesting the panic it created. It triggers your stop. Your forced sell order hits the market. That sale adds momentum. That momentum triggers the next trader's stop. That trader's panic accelerates the move further. It's a cascade. And the exchange engineered the initial spark. Here's the genuinely eerie part. Sometimes, within just 5 to 15 minutes, the price reverses. It comes back, and it often closes green on the day, which means the closing price at the end of the trading day was higher than the previous day's closing price. So the body of the candle on the chart appears green in color. The bottom line is that stock gained in value over 24 hours, meaning investors who bought at yesterday's close made money today. But unfortunately, you had a stop-loss order in place, so now you're sitting there stunned, having sold at the absolute worst point, then watching the stock recover to where it was before the initial dip, and then go on to rise in value above your purchase price. You just fed thousands of dollars to the exchange's algorithm monster for the privilege of learning this lesson. Again, the algorithm doesn't care about the stock's fundamental value. It doesn't care if the company is profitable or if earnings are good. It cares about where your money is most likely to panic exit. That's the entire optimization function. Phase 3 is the consolidation and reload. After the spike triggers maximum stops, the price stabilizes. It retraces. Retail traders, fresh from losses, become risk-averse. Volume drops, and the algorithm quietly pulls back, waiting for the next cluster of fresh stop losses to form at a new price level. This happens dozens of times per week on liquid stocks. Every single spike toward a resistance level isn't organic price discovery. Most of it is programmatic liquidation hunting. Once you know about this stuff, you might think, it's rigged, I should stop trading. And that's a valid, honest response. But it's also what the system wants you to think, because resignation is profitable for incumbents, because competition is leaving. Or you can flip the asymmetry. If you understand that stop losses trigger algorithmic liquidation hunts, you can use that knowledge. Sophisticated traders don't place stops at round numbers or obvious support levels. They place them in the noise, below major clusters, in the white space where the algorithm doesn't expect to find many forced sellers. That single decision, placing your stop 1.3% lower instead of at the clean support line, can mean you avoid the liquidation game and watch your position recover. But understanding the mechanism does not make you smarter than the machine, because the algorithm learns and updates, so the exchanges update. The game is not static. For every trader who learns to hide their stop loss in the noise, the algorithm learns to look for stops in the noise. The system evolves to consume your knowledge. This is the part that breaks most people's faith in markets, because it means the game isn't about fundamental analysis or technical skill. It's about information asymmetry. It's embedded in market microstructures. It's how modern exchanges are engineered. Your broker probably doesn't explain this because your broker profits when you trade. When you panic sell on a spike, your broker gets transaction fees. When your stop triggers, your broker gets fees. The entire ecosystem is aligned to accelerate your liquidation, not protect you from it. The real move, the one that actually builds generational wealth, is understanding that you're playing a game where the house controls the board. And then deciding, am I playing to beat the algorithm, or am I playing to ignore it entirely? The traders who build generational wealth rarely use stop losses. They use position sizing. They risk only 2% per trade. They accept that spikes will happen. They know their stop loss is their account size, not an algorithmic trigger. That removes them from the liquidation harvest entirely. The algorithm can only profit from your pain if you've positioned yourself to be in pain. That's the thing about the secret exchange pricing mechanism that nobody emphasizes. It's not actually secret. It's just invisible because it operates at the substrate level of how markets work. The mechanism is how modern markets work. The question isn't whether it exists. The question is whether you're going to let it consume your capital for the next decade, or whether you're going to architect your trading around its existence. Stop asking if markets are fair. They're not. Start asking if you're positioned correctly within an unfair system. That's the question that breeds generational wealth.